Let's talk money.
Hello and welcome to this week's edition of Let's Talk Money with me, Surabhi Upadhyay. Insurance, insurance, insurance. That's what today's episode is going to focus on. Now, the insurance regulator, IRDAI, has recently approved a number of changes to the manner in which surrender value is calculated for life insurance policies. Now, this is extremely important because in case a policyholder wants to exit the policy or give it up after, year 1, year 2, or year 3, how much money will the policyholder get back? That is what has changed, and we need to understand the implications of the same. So we'll discuss this. And hold your breath, and I know this is something you'll really want to understand. Cyber insurance. We keep hearing about the rising incidence of online frauds, fraudulent transactions on debit cards from our savings accounts. So is there a way to get a cover to protect ourselves against such fraudulent transactions? Yes, there is. And the person who will tell us all about it is Rahul Agarwal, CEO and co-founder at Ideal Insurance Brokers. Rahul, thank you so much. And it's great to have you back on, Let's Talk Money. You've, of course, been with us in earlier conversations on money, money, money. Welcome to the new edition of the show.
Thank you, Surabhi. I'm glad to be back.
Okay, so, we thought we'll start by talking cyber, but then so much has happened in the last couple of weeks on life insurance and surrender value. So we want to start there because viewers have been asking questions saying, what does this mean? Is it a good thing? What happens if I, give up my policy now? Your thoughts on what we've heard from the IRDAI in the last few weeks?
So, of course, it's a great initiative by IRDA and it is a completely consumer pro thing. Right? Previously, what used to happen that if unfortunately somebody has to surrender the policy in the initial few years, not only in the first 3 years, even a little later, then people used to lose a substantial chunk of their investment, right? Which IRDA is now rectified. And now if you have to shut down the policy in the early years, you get a good amount of money back. So which will actually help the insurance industry also because it will create more confidence in people, okay, who wants to buy policy. It will actually increase the sales, what I feel.
Oh,
so
okay.
it's good for everyone.
It's like a reform measure coming in the life insurance space, the non-term life insurance space. Okay, let's take a couple of steps back, make it very basic and try and understand what is surrender value, what all policies offer a surrender value if we are, submitting or exiting those policies back. So let's start from the basics.
So first of all, what is surrender value? So when you, so let's say you have taken a life insurance policy for 15, 20 years, which normally people take. But unfortunately, for certain reason, you have to surrender the policy before that. Maybe you're not able to pay the premium or you are in bad times. So then you get some money back from the insurance company, which is called the surrender value for that year. And it is defined for every year. Right? Now, previously what used to happen that if you surrender the policy before 3 years of completion, you don't get any money, right? Zero money. And even if you surrender after 3rd year, you get around 30 to 35% of the premiums that you have paid in 3 years. Right?
So till now, if you were trying to close out a policy early, prematurely, you were only going to get 30 to 40%.
Yes, of the
your
premium
total
paid.
premium back.
Yes.
In fact, I've heard instances, Rahul, and correct me if I'm wrong, I mean, there are instances where people say that it's become extremely difficult to close a policy, a premature closure. Companies, insurance companies simply don't allow it. And they ask for so much paperwork that you just buried somewhere deep in that.
Yes, but more than the paperwork, it's actually a huge financial loss for anyone who wants to do that, right? Or if you're stuck with the wrong policy. But now, so which has been rectified, now if you surrender the policy, even in the first year, you still get about 63% of the money back in the new rules.
Okay.
So previously, which was 0, now it is 63% in the first year. And if you surrender after the 3rd year, then on an average, you get about 70% of the total 3 years premium paid. Okay. So which is a huge difference from before. So this is what it has changed, and it is applicable to all traditional policies, basically all return-based policy in which you make some returns. It is of course not applicable to term insurance, right? Because term insurance is the only risk policy. But for any other policy where you make returns in the policy, it is applicable.
Okay, so barring term, all other formats of life insurance products will offer these higher surrender values now. Also, Rahul, I believe that within surrender value, and it's very complicated, but there are 2 different types. I think there's something called a guaranteed surrender value, then there is a special surrender value. What is it that the policyholder should focus on?
So basically, guaranteed surrender value was again a surrender value which was guaranteed by the insurance companies before, but which were also very low.
Okay.
Right? But now the special surrender value is the new surrender value which has been dictated by IRDA. They have linked it to basically the government bonds return, but let's not complicate it for our viewers. So simply the special surrender value is the new value which has been decided by IRDA. If the guaranteed surrender value is more than special surrender value, then of course the guaranteed surrender value applies, but normally it is not. Right? Whatever the surrender value which was offered by the insurance companies, that is much lesser than now what is offered.
So this is the new special surrender value which we need to focus on, and it's linked to the rate of the 10-year bond yield, the government bond yield. So that also means that it will keep revising. It's a dynamic thing depending on how the market rate.
It is, but knowing that the 10-year government bond does not fluctuate too much, right? It is not going to affect too much. So from 70, it may come down to 65 or 75, but it is not. It is still be much better than the 30% which was offered before.
Okay. Now, while looking at the calculation of how much money you'll get back in case you're closing your policy early, is it only a function of the amount of premium that you've paid, or are there any other sort of things that are taken into account, like bonus, etc.? How does the computation come?
Very good question, because let's say somebody has even paid for 3 years, then you have also made some returns on those 3 years premium
on that policy.
But the bonus becomes applicable after the 4th year. Right now, after the 4th year, you get almost 70 to 75% of the premium plus bonus, which was earlier 50%. So even the bonus part has been increased, although the bonus is still applicable only after the 4th year, not till the 3rd year. Okay,
so you will get a bonus on your policy only after the 4th year. And while calculating the special surrender value, the computation will take into account the premium that you've paid as well as the bonus amount. So then the amount you get back becomes even higher.
So previously, let's say you have completed 4 years of the policy.
Maybe if you can explain with an example.
So that's what I'm saying. Suppose previously you have paid 4 years in the policy, so now you are eligible for bonus. So previously, if you surrender the policy after 4 years, you would have got about 50% of the premium plus bonus. Now you would get about 75% of the premium plus bonus.
Substantial increase.
Very much, a lot.
Okay, fair enough. We have some questions coming in because viewers obviously want to understand how to implement all of this. Let me take some of the queries that we have. I think this is a question coming in from Rajendra. He's with us on the phone line. Rajendra, hi. How can we help you? Tell us, what's your question?
Policy I'm looking to surrender had premiums payable on quarterly basis. Am I eligible for a surrender sum from the insurer?
Okay, Rajendra, thanks for asking us that. I forgot to check this up. So some policies have annual premiums, some policies like his have quarterly premiums. So what happens now?
So your surrender will only be applicable after the completion of the 1st year. Right? But yes, let's say if you have paid 2 quarterly installment and if you surrender, you will get your money, but after the end of 1st year, you will get about 62% of the 2 quarterly premiums paid.
So even if you've paid only 2 premiums out of the full 4 premiums of the year, you'll still get a portion of that money back. Okay.
Or let's say somebody has paid 6 installments, 1.5 year. So on the completion of 2nd year, you would get about 67% of your money back.
Okay, got it. And for single premium policies, it's straight up.
Single premium, normally they have anyways much higher surrender values. Okay, so single premium are more investments, they are less of insurance. So their surrender value is normally anyways 80-90%. So it doesn't matter.
Oh, okay. So there the surrender value can be as high as 90%.
Yes, because they are more like just a one-time FD kind of a product with some insurance element in that.
Wrapper kind of tied to it. Okay, fair enough. Got it. Now I think we have one more question. This is also Rajendra. Actually, Rajendra, you're still on the line. If you can hear me, I believe you have another question.
I am looking to buy a new life insurance policy. Should I get one now or wait till October to get a higher surrender value?
Okay, I guess, Rajendra, the issue is when do these new norms kick in? Rahul, help us with the interpretation. Are they applicable to new policies issued after October?
So IRDA has given a dictate to the insurance companies that they have to implement this latest by 30th September. So some companies may implement this before 30th September, but from 1st October, you have to. So before buying a policy, if you want to buy a policy right now, you can check with the insurance company whether they have implemented it or not. Otherwise, you can wait, till the time they implement it.
Okay, all right. So that's as far as the implementation goes. Rahul, I mean, typically, let's go back to the drawing board, right? Why are we having a conversation on surrender values? It is because you want to get out of a policy.
Yes.
Now, you want to get out of a policy in some cases because there's a financial crunch, or you might want to get out because it was not meant for you in the first place, right?
Yes.
So going back to Insurance 101, what are the house rules that someone should keep in mind while buying non-term life insurance?
You've already given the house rules. So these are primarily the reasons why somebody has to surrender the policy. And if you're in a very bad financial condition, otherwise there's no reason that somebody buys a policy today and would want to surrender after 2, 3, 4 years. It's only when you are in a financial crunch, or if you realize that you have bought a wrong policy, or somebody has missold you a policy, which is again quite common.
How to avoid that? That's my question. That how to ensure that you're not buying something without thinking. What should you think if someone comes and tells you, hey, this is not term insurance, it is another life insurance policy, and consider it. What should one think?
I think we can have another show on that.
We can have we can have a whole series on it, and I think we should. But
So in fact, I have a note on 10 things before you buy a life insurance policy. I'd love to share with you that. But yes, right now, the first thing is 2, 3 important points which you should look at. Right now, first, when you're buying a policy, there are a lot of good guaranteed return policies which are offering you 7% guaranteed. So go for those policies. Second, go for policies which give you higher cover, right? And third, and most importantly, look at the pain and payout. Okay. Normally, what happens, the biggest mis-selling which happens, that people are told that you have to just pay for 3 years or 5 years, whereas you actually have to pay for 10 to 15 years. So make sure that if you are told that you have to pay for 5 years, then that is what it is written in the policy. Otherwise, if you are willing to pay for 10, 15 years, buy a policy accordingly, right? And the money back also, be sure on when you want the money back, right? Let's say you want it for your retirement or for your kid or for some marriage. So ensure that the pain and payout periods are exactly defined properly in the policy, whatever the intermediary have told you, right? But read the offer document carefully, right? So if you just take care of these 2 things, I'm sure you will not make a mistake.
And always remember, insurance is a subject matter of solicitation. So make sure you know all the fine prints before you decide on buying that policy. Okay, great. That's the first leg of our conversation because this is the hottest topic on surrender values. But after the break, we'll come back and discuss something that's really critical to understand. Cyber insurance. Can we cover ourselves against potential online fraud? More on this in just a bit.
Let's talk money